Good evening, folks. Last night we began speaking about intro to Tradovate, how to set up your layout in order to best be able to execute your trade ideas in the market. This evening we're going to be taking just one step back and talk about some of the things that you need to be aware of before you begin trading futures. And we're going to start once again with your broker. And what is a broker and why do you need a broker? In the futures markets, there are different, shall we call them, participants. Um, the trader, you, the end user, being one of those participants. In the middle, if you can think of a graph, in the middle between yourself and the exchange where orders are matched, buyers and sellers are matched, is your broker. So you can think of it as a three entity situation where you have the trader sitting at his computer or his phone entering orders. You have the broker, which is the intermediary between the exchange and whoever is taking the other side of that order, whether it be a buy or a sell. So the broker is the intermediary that you deposit your money with and provides you with a software platform to be able to interact with the futures products that are available. The exchange on the other end of the spectrum simply deals with matching orders for buyers and sellers, finding a buyer for every seller and finding a seller for everyone who wishes to buy. So, why is your broker important? Well, because if we are going to treat trading as an enterprise or a business, or it be a pursuit that we take seriously, then we must know the costs that are involved. There are life costs that are involved, but there are financial costs that are involved also. And most of those costs is incurred through interacting with your broker. So let's just take a look at what some of those costs might look like. So one cost is called commissions. Every time you execute a trade, you will pay a fee to your broker. That fee is called a commission. The commission includes a small portion that it goes to the exchange, and then there is a portion that your broker themselves consume. So that is one cost that you're going to face before you ever make a profit or a loss. In some sense, you're already in negative because you have to pay for every time you click that buy or sell button. Your broker and the exchange gets a fee for that privilege, so to speak. Then, because your broker gives you software on which to execute your trades, there are some brokers that will charge you what is known as a platform fee. That may be a fee that you pay monthly, or in some cases you may pay annually, or in some cases you may pay a one-time fee that gives you the platform's availability for life. So, for example, we were talking about Tradovate last evening. Tradovate does not have any platform fees. Although you are able to use their platform in many different areas, such as through your browser, through your tablet or your mobile device, or through a desktop application, there is no fee for using the Tradovate platform. There are other brokers such as Ninja Trader. Um, there are other brokers such as interactive brokers who may charge fees for certain items of their platform. You have futures brokers futures platforms like Thinkorswim by TD Ameritrade that does not have a platform fee but will have other fees again, such as the commissions and uh, the data feed fee, which is the next fee that or sunken cost that we're going to get to. So, in order for you to have real time quotes coming into your software, the exchanges also do sometimes charge a fee that your broker then passes on to you or that they absorb themselves. For example, TD Ameritrade's Thinkorswim, they absorb the costs of your data. So you do not pay any additional cost to receive real-time data on Thinkorswim, but on Tradovate you will pay for data. So we're looking here at market data offerings, just so you have a very clear idea as to what I'm referring to when I speak about market data. So each exchange has different products that are trading on it. For example, the CME will have products such as the S&P 500, the NASDAQ 100, the Russell 2000. Those products are offered by the CME, the Chicago Mercantile Exchange. And so for me, I am happy to pay for data on my platform for the CME products because those are the products that I trade most often. Whereas things like oil or gold um, that may come on other traders' radars and that are traded on other exchanges, I do not subscribe to that market data. So in that case, you can see here, you can pick and choose what sort of market data you would like to have on your platform. So market data is one of those costs that you will incur. Another thing to consider when you're looking at brokers is what sort of restrictions or permissions they may have in terms of how much money you may need in order to open an account. What are the margin requirements in order to trade certain contracts or products that you are interested in trading? How much margin or do they allow for overnight trading, i.e., beyond the hours of 6 p.m. Eastern Standard Time? And are there any restrictions on the number of contracts that you are or have available to trade? So, for example, for the Tradovate platform, I believe that their minimum initial deposit in order to open an account is $250. So that will vary from broker to broker. Some you may have to deposit 500 US, some maybe as large as 1500 or 2000 US in order to open an account. But in with this particular broker, Tradovate, I know the minimum initial deposit is 250. So let's talk about margin requirements. Margin requirements simply means the amount that you must have in terms of your free balance in your account in order to be able to open a trade. So for the ES, which is the S&P 500, the margin is $500 on the Tradovate platform. What does that mean? It means that I must have a minimum of $500 US in my account, not being used in any other trade in order to place a buy or sell order for that particular contract. So let's say, for example, I had an account balance of $2,000 and I wanted to place a trade on the S&P 500. I would be able to open a buy or sell order on the S&P 500, but my available margin would then be decreased by $500 because I'm using that for the open trade that I have. Now, that probably wraps up what we need to talk about in terms of considerations that you need to make for your broker. Why is that margin requirement so important? Because it essentially increases your leverage depending on the size of your account. Let's say, for example, you have an account that has $10,000 and one broker is charging or has a requirement for $500 on the ES. That means at maximum you could open 20 contracts on the ES. I would never recommend you do that, particularly starting off, but you could possibly do that. If you were to go to a broker, for example, that had $250 margin requirements on the ES, the S&P 500 futures contract, then you'd be able to do twice the number of contracts for the same amount of money. This is why most market participants gravitate towards brokers who have fairly liberal margin requirements so that they have more leverage or more bang for their buck. Of course, leverage is a two-sided sword and it can fall both ways in terms of amplifying your returns and amplifying your losses as well if you are wrong. So that is one of those things that we need to get very clear before we begin trading, is be familiar with the choices that you have when it comes to brokers.